Saul Eslake is an independent economist. He joins us now. Saul, terrific to have you back on Ausbiz. Good to catch up again. Fairly quiet, certainly locally Monday, given much of the country is on holidays. Let's start stateside. Of course, it's overwhelmed at the moment by that government shutdown. As a result, markets tend to be flying a little blind, don't they? Because there is that absence of data releases.
Well, yes, and we saw that on Friday when the expected employment data, probably the most important monthly data in the US data cycle, wasn't released. I mean, you could say President Trump found a different way of avoiding the publication of data he didn't like beyond simply sacking the head of the bureau responsible for producing it. But typically after the employment data, there's usually a lull of about 10 business days before we get more data for that month, such as retail sales, industrial production, housing starts and the like. We may or may not get the trade data for August that is due to be released by the Commerce Department. I'm not sure whether they'll have been affected by the shutdown in the same way as the Bureau of Labour Statistics and the Bureau of Economic Analysis have been, but it could be that US markets will be flying blind for an extended period if the shutdown isn't resolved quickly, and that does create the potential for more than the usual amount of volatility.
So I'm interested to get your reading of what you're seeing in the US economy at the moment, particularly with that focus on jobs. Now, clearly that's where the concern of the Fed lies if it's needing to cut rates further. There's already weakness in the jobs market. That's been exacerbated by the crackdown on immigration. And now we hear that Donald Trump is perhaps looking to make those temporary layoffs during the shutdown permanent.
Well, at face value, all of that, the slowing in employment growth and the possibility of bigger reductions in the federal government's own payroll would point to the risk of unemployment moving upwards. But of course, if the rate of growth in the supply of labour is being curtailed as well by the government's crackdown on immigration, then unemployment could remain relatively low, even if employment growth weakens significantly, and that would appear to have happened over the course of this year. We've seen, at least up to August, a very significant slowing in the rate of growth of payroll employment, but the unemployment rate has remained reasonably low, and there haven't been any significant upward movements in the weekly measures of initial claims for unemployment insurance, which is usually a harbinger of increases in the unemployment rate. Of course, the fact that the supply of labour is slowing significantly because of the immigration cutbacks and the demand for labour is also slowing does point very strongly to a slowing in overall economic growth. And although that perhaps isn't immediately obvious from the most recent quarterly GDP numbers that were subject to some benchmark revisions a couple of weeks ago with the final estimate of US GDP growth for the second quarter, if you look through the very big swings that have occurred in imports over the first half of this year, with a big rush of imports in the first quarter as people were trying to get goods into the country before the tariffs hit, and then a subsequent big fall in imports in the June or second quarter, if you look through those and focus on final domestic demand, that has clearly slowed quite noticeably in the first half of the year. Now, it would be an exaggeration, I think, to say that the US is headed for a recession, but I don't think there's any doubt that growth in the US economy has, in an underlying sense, slowed. And if it wasn't for that, then I suspect the Fed wouldn't have cut interest rates last month and wouldn't be poised to cut them again, possibly twice, over the remainder of this year, because there is still a legitimate concern, as Jerome Powell has pointed to, about the impact of the Trump regime's tariffs on inflation. You know, they have kept inflation well above the Fed's target of 2%. The measures of inflation that the Fed focuses on are sticky in the high twos at the moment.
Meanwhile, so closer to home, as I mentioned, the RBNZ has its interest rate decision this week. Would you agree 50 basis point cut is on the cards? How would you describe the Kiwi economy at the moment?
I'd certainly think a 25 basis point cuts is more or less a done deal. 50 would, I think, surprise me. Not everyone. It would surprise me if they do 50, because after all, the New Zealand cash rate is now down at 3. Taking it down by half at 2.5% would be a big move. There's no doubt that the New Zealand economy has paid a much higher price for getting inflation down to acceptable levels than the Australian economy has done. The New Zealand unemployment rate has risen from its pre-hike low to its most recent level of 6.1%. That's an increase of 2 percentage points, and it would have been a much bigger increase except that New Zealand has a safety valve for periods of economic weakness and rising unemployment. It's called Australia, and quite a lot of Kiwis have come over here in search of better job prospects and better pay than have been on offer back in New Zealand. New Zealand had, I think, 4 quarters, not all of them in a row, but 2 periods of consecutive quarters of negative growth in real GDP, even though for some of that time they had faster proportionately population growth than we had. So the Reserve Bank, with the benefit of hindsight, and it's always easy to say this with the benefit of hindsight, tightened more than it needed to, pushing its cash rate up to 5.5% in order to bring inflation down. And now they're cutting rates more aggressively than the RBA or the Fed or the Bank of Canada and the Bank of England.
Well, let's get to the RBA then. Saul, the outlook there. Now, last week, of course, we heard from the Governor, Michelle Bullock, describing the cash rate at the moment as mildly restrictive. What do you think the neutral rate looks like?
Well, the Reserve Bank's own models that they've published in their quarterly statements on monetary policy from time to time suggest that the neutral rate might be somewhere in the high 2s, say between 2.75% and 3%. But the Governor herself has been suggesting that she regards, that the Reserve Bank Monetary Policy Board regards neutral as being about 3.1%. For myself, I prefer to say that it's somewhere in the range of 2.75% to 3.25%. Whatever it is, at 3.6%, it's still at least modestly restrictive. Markets interpreted Ms. Bullock's comments after last week's meeting as downplaying the prospects of a 4th rate cut for the year at the November meeting. That's a plausible interpretation, to be sure, although I think she seemed more anxious to be downplaying the significance to the Reserve Bank's decisions of the monthly CPI indicators, and she seemed to be saying that they were going to continue to put little store by those even from November, when the ABS is saying that its monthly CPI indicator will be more comprehensive. They'll continue to focus on the quarterly numbers. I'd also note that the monthly trimmed mean measures of underlying inflation haven't been a good guide to what the quarterly measure will say. So I'm still, for myself, inclined to think that when we get the September quarter CPI in late October, it will print an annual underlying inflation rate sufficiently close to the midpoint of their target band that further reduction of 25 basis points in the cash rate at the Melbourne Cup Day meeting is, I think, still very much a live option. And although 3 of the 4 banks have now walked away from prediction, I'm still inclined to think it's more likely than not that we'll see a 4th rate cut at the November meeting.
So obviously, central banks across the globe, including the RBA, trying to get that balance right between inflation and jobs. Where are you seeing that locally? Is there a risk that inflation could break out? And at the same time, in terms of the jobs market, can it maintain its resilience, do you think?
Well, I think it will find it easier to keep the unemployment rate somewhere between 4 and 4.25% because immigration to Australia is clearly slowing. Population growth is slowing. The rate of growth of the supply of labour, the working age population, is also slowing. So we don't need to create as many jobs in order to keep the unemployment rate at somewhere around the rate that's consistent with full employment as is now defined in the agreement between the government and the Reserve Bank Monetary Policy Board. I think the Reserve Bank, in contrast to its peer on the other side of the Tasman, has done a pretty good job in getting inflation down to tolerable levels with a very small cost in terms of economic growth foregone and increased unemployment. The unemployment rate is now only about 3/4 of a percentage point above where it was before the Reserve Bank started tightening monetary policy in mid-2022. That contrasts with an increase of around 2 percentage points, as I said before, in New Zealand, and with a similar increase in Canada. And we've achieved a fall in inflation to acceptable levels with a small increase in unemployment without having to run budget deficits of in excess of 6% of GDP, as the US has been doing to keep unemployment relatively low. So, my view is that the Reserve Bank deserves more credit than many people have given it for the way it's conducted monetary policy over the last couple of years.